So we're in the classic situation that baffles people about the economy. The economy gets better, the markets get worse. That's the story of the week, right?
It really is the
Tell
story
us why.
right now, and the economy is getting better, probably better than it's been in each of the prior 3 or 4 years we've been in this recovery.
And the latest evidence is housing's improving on all fronts.
Housing is improving, and consumers are really showing some fairly strong optimism and are powering this recovery right now. That's the divergence we're seeing. Consumers are optimistic, businesses are still relatively cautious, and businesses are seeing the troubles around the world brewing and perhaps growing more cautious as we go along.
And then this week, Fed Chairman Ben Bernanke basically said, we think things are getting a little better too. And everybody in the markets went, oh my God, what's that all about?
Exactly. So the perfect scenario for markets has been a modestly improving recovery, because that means the stock market continue rising, the Fed would continue easing, and you'd be in a Goldilocks scenario where things aren't getting too hot. Now they're seeing this, and what the Fed chairman did this week was to lay the marker for when the Fed is going to pull back on its easing. As unemployment gets down to 7%, we're going to see the Fed really pulling back as it's pulled back.
What I don't understand why that wasn't exactly a Goldilocks moment, what Ben Bernanke said this week, because he said, we think it's getting better, but not really too fast. We're going to wait and see before we do anything. Maybe we'll slowly start to taper off our bond purchases, and maybe next year we'll actually be out of this phase, but maybe we won't be. I mean, that's like the total Goldilocks prescription.
Well, I think that to some extent it illustrated how the markets have become addicted to low rates and easy money. And when Bernanke said, we're not going cold turkey, but we're going to start to give you a little less of this stuff, that seems to have had a big effect. Some people in the markets may think that the Fed, all this adds up to the Fed raising interest rates a little sooner in 2015 than they had previously anticipated. And some of it is just crazy volatility, animal spirits, and you never can quite
People
figure
are
it out.
having a very difficult time getting around the idea of the Fed someday not being involved in the way it has been. We've had 4.5 years of near zero interest rates. We've had year after year of different bond buying programs, and we're probably going to get to the 6-year mark of zero interest rates before there's any prospect of coming out of it. But that's a very long time for
But somebody asked me this week a logical question, and you mentioned businesses aren't quite convinced yet. So if interest rates are near zero, why wouldn't you, if you were a business, be borrowing as much money as you possibly could and investing it in, plant, equipment, workers, because you're going to have this money for a long time at no interest rates, and eventually it'll pay off? Why aren't they doing that?
Well, the growth in the U.S. around 2% is still 2% growth. It's not good enough to expect much more in the coming years. And if you look at around the world, a lot of American businesses are getting half their revenue from around the world. And Europe is still in a meltdown. Asia is showing more signs of weakening. Just about every emerging market is watching their equity market go into a tailspin right now. So you have to be a little cautious if you're a business owner, wondering what's going to happen. And the Fed has to be a little bit cautious too. Year after year, even as the U.S. economy started to firm, you've seen things in Europe and in Asia start to fall apart, and it could happen again.
And Bernanke made clear yesterday, if the thing doesn't perform as I expect, we're not going to go through with throttling back on the bond buying or raising interest rates on schedule. So he tried to convey that.